Hey dreamers, with all of the volatility in the market, I thought I'd give you my perspective in case it's helpful as you're navigating all of this churn. I'm going to start this whole thing out with how much I am down right now, because I feel like if I only talked about how much I'm getting paid from dividends and how much my net worth goes up and up, that wouldn't really be an accurate representation of how it feels to be an investor sometimes. In fact, on January 7th, I posted a video on my net worth. But by Jan 14th, the market had started to lose steam. So as of today, I'm down over $50,000 in just one of my accounts alone, and down another $20,000 in the other account. So overall, I'm down about $70,000 in under 2 weeks. But just like I don't get rattled with fast increases, I don't get rattled by fast decreases. I'm going to show you indices of the current volatility, how it affects certain sectors of the market, and most importantly, why this is a good thing for dividend investors who are long-term when you put it in perspective. So this is the Fear-Greed Index, which is a simplified version of several statistics such as market momentum, the VIX, volume of trades, demand of so-called safe assets like bonds and gold, etc. And we can see here that the market is currently leaning towards fear. The reasons widely reported on are inflation concerns, the U.S. Fed tightening spending, and of course, the unending pandemic. Throw in a possible Russia conflict and you've got people concerned. But let's dig a little deeper into the VIX, which is a key indicator underneath this. Yesterday, we had the highest level since the election in November 2020 as it crossed above the 37 mark. But what's the practical way to think about these numbers as an investor? We'll take a look at this chart from a recent article in The Street. Basically, their research indicated that the optimal returns were achieved when the VIX moved above 33. On the other hand, it's optimal to sell if the VIX moves below 12. They go on to say, the higher the VIX, the higher the forward-looking returns have been. The greatest returns, not surprisingly, come from cyclical and growth sectors. You can see that here in industrials, financials, consumer discretionary, materials, and tech. Whereas non-cyclical steady eddy sectors such as staples, healthcare, and utilities look a bit different. The converse is also true. Some of the lowest forward-looking returns came from when the markets were at their calmest, right here in the middle. Now, as you know, I'm a long-term investor. But there are opportunities to exploit the markets if you're willing to swim against the tide and be a buyer when everyone else is probably selling. So let's take a look at where money is flowing in and out right now. So here we see money starting to flow out of tech. We see the communication services like telecom really a bit oversold. So that really has kind of been flat over the last week. We see money starting to leave consumer discretionary and go into consumer staples. We also see money going into energy significantly. Money starting to leave financials, leave industrials, and materials are pretty flat. We see healthcare a little bit flat over the last week. Real estate slightly up, utilities slightly up, and then commodities flat, with the bulk of that going into gold, which is a typical fear response. So that's what the herd is doing in order to fortify their positions, they think, in the short term. My perspective on all of this is, as a dividend investor, I win in any market condition, no matter if it's up, down, or sideways. So that helps me crowd out the noise in times like these. I'm always amazed by how simple and rewarding dividend investing is. There are actually several ways dividend investors win. One way is obviously the dividend income based on yield percentage itself. It doesn't matter if the market is up or down, you still get paid your dividend as long as you're holding great companies with a long history of dividend payouts and a solid balance sheet. A good payout ratio with enough free cash flow to pay that dividend. And if you're interested in seeing examples of stocks I invest in, you can watch my favorite Canadian stocks, my 10 cash flow Kickstarters, or really any of my monthly updates. The next way dividend investors win is through dividend increases. If you're looking at dividend aristocrats, contenders, or challengers, these are lists of stocks that not only have a long history of paying out, but also have a long history of increasing their dividend payouts every single year. Typically, there's one increase per year, and the announcement timing varies based on company. But increases can be small, like 1 to 2%, or they can be much larger, like 10 to 30%, or even more. So that's the second way you win, that yearly raise you get automatically from your dividend stocks. Now, if you have your drip on, which is where you're buying more shares with that dividend automatically instead of receiving cash, you can imagine how it just grows and grows. But let's for a second assume no raises occur. And let's just take a look at how compounding works with that simple reinvestment. Okay, so here we are at dividend.com, and this is actually my favorite compounding calculator because it's just easy to do and understand. So let's put some dummy data in here. Let's say you're starting out with $200,000 and you have a yield of 5%, and you want to see how that plays out over the next 30 years. So what you see here is that first year you, at 5% on $200,000, got $10,000. And so by the end of the year, you have $210,000. Makes sense, right? But then you're starting the second year with that $210,000, and it makes you $10,500. And it grows and grows as time goes on. So how long does it take to gain $100,000? Well, let's see here. So we go down a little bit, and we see that by year 8, we have $295,000. So it took about 8 years to get to $300,000. How long does it take to get to $400,000? Let's go down a little bit farther. So we've got, let's do this together, 1, 2, 3, 4, 5, 6 years to get to $400,000. What about $500,000? 1, 2, 3, 4, 5 years to get to $500,000. We've got 2, 3, 4 years to get to $614,000, and then 3 years to get to $711,000, and so on. And so at the end of this 30 years, you have $864,000, and that's just by starting with that initial $200,000. Getting a 5% yield, doesn't take into account the increases in every single year in those dividend yields. So just that $200,000 at 5%, just continuing on, is netting you $864,000. Pretty good. So what's the final way we win? Well, stock price appreciation. As a long-term investor over 10 to 30 years, the probability of increasing stock prices is high. But if you can stomach taking advantage of fear dips in the short term, your likelihood of price appreciation goes up even more. As you know, I'm not a financial advisor, but I can tell you what I'm doing, which is carefully and smartly deploying cash where it seems like there is an opportunity due to fear in stocks, especially on stocks that I already own and have done my research. You know, I've learned that the longer you're an investor, the less these kinds of pullbacks really affect you mentally. So as I always say, in the storm, when the waves are crashing and everyone is swept in one direction, swim against the tide. So there you have it, the ways in which dividend investors win: dividend income, dividend raises, the compounding effect, and price appreciation. Okay, guys, thanks for watching. Keep learning, keep implementing, do your research, and then put it into practice. Keep in mind these videos are for entertainment and inspiration only, and I'll see you on the flip side.